Okay, this is going to be a very nerve-wracking 20 seconds here. I'm kind of waiting for the live stream to kick in and so I can see some comments, and I know that everybody's here today. Come on, YouTube, kick in for me. I'm usually nervous about, here it goes. Looks like it's happening. There we go. Yeah, I'm usually nervous about doing the stream itself, but today I'm actually nervous that it wasn't going to work again. So I'm not going to harp on it too much. I don't want people waiting too long. We're going to get right into the Iron Condors course. But essentially what happened yesterday, I owe a lot of people a huge apology because I tried to use a new service. It's called Restream. And sounds really cool. It's supposed to take this YouTube live stream and blast it out to a bunch of social media platforms at the same time. So I can go on Facebook and LinkedIn, and one live stream can go to all of my audiences at once. And it actually technically worked, but the problem was when I launched this YouTube, it makes a brand new link as soon as you click go live. So of course the link that I gave everybody, come check out the live stream, I sent it out in my daily email, I sent it out on Twitter, everybody was waiting at the wrong link, and the brand new one just kicked in and there's nobody there. So I think I left a lot of people stranded on a dead link yesterday, and I definitely apologize for that. I really do want to try that restream, so at some point in the future, what I'll probably do is announce it as a Q&A session only that will very likely fail. And I'll announce it that way. I'll make sure that everybody knows ahead of time that, this is pretty dicey, might be 50-50, and then I have to get it going. I think it'll be really cool to have people on all the different platforms being able to watch it. So to be continued at a future date. But today we're going to make sure this works. I do have something to present today, just for everybody watching. Of course, thank you for joining. My live streams are free, they're public, and I don't use them as a marketing thing. I try to keep the private VTS stuff out of the live streams as much as I can. Of course, don't pay me any money. Don't use any of the YouTube functions. Don't super chat me or pay money for any questions. You can always ask your questions for free. Just put a Q or a question in front of it so I can pick it out of the chat really easily. But yeah, it's totally free. But when I have something to present, of course, this is a pretty good medium to do it because it can sit there on YouTube forever, and I'll always have that to reference back to. So I'm going to present what the new course is and leave it open to everybody to see whether they want to actually join or not. So this is something that for VTS community members, it's completely free. It's just something that I'm going to do for them, just an extra education thing. But of course, anybody who's not a VTS member, no pressure, but there is a way to join the course. So let me actually break it down. So what it is, I think the first thing that I will do is I want to actually show one of my emails, daily emails, and I'm going to show you where this Iron Condor strategy fits into my actual portfolio first, and then I'm going to get into the course, how I've laid it out, what exactly is going to be in it, and what people are going to get if they participate. So first of all, let's see where this actually fits into the portfolio. So this is actually the actual email that I sent Friday, so yesterday. This went out to the entire community, July 22nd, 2022. And I'll just go top to bottom in case people haven't seen this. Maybe they'll think it's kind of cool. I'm going to rip through this quite quickly. So, some of you have obviously get this every single day. You're like, yeah, I know this already. But for anybody who hasn't seen it, I always make it pretty clear from the start whether there's a trade or not, because there are a lot of people who just follow the portfolio and they don't really dive into the education. And that's completely fine, of course. You can use VTS any way that you see fit. Some people use the education plus the trades. Other people just want to say, hey, is there something? If not, they kind of just go on about their day. But of course, at the top, the volatility barometer is one of the best metrics that I use to actually decide on some trades. So people will want to check out that video, of course. Everything in my daily email that has a blue link means there's some type of secondary article or video, in many cases both, where people can, if they're interested in what they see, they can actually get the further education. Again, not required to follow the portfolio. You could just take the trades blindly, but sometimes people like to know where that actually comes from. So volatility barometer in a chart form as well, so we can see where it's come. This is a 2-year rolling chart. We've got the volatility dashboard metrics that I feel, they're all sort of useful for their own way, but I feel like the specialty ones are probably extra useful as filters for trades. So of course you can go into each one of those and figure out what they are. I like to show things in percentile ranks, long-term median. People can get an idea for where we are currently at in the market by looking at all of these metrics every day. This one's kind of cool. I think I get a lot of emails about this. People like it. Basically the 5 main volatility ETFs, I calculate every day based on how they actually function with holding the VIX futures and the roll yield, and calculate how much they're either decaying or surging. I call it the crush surge dashboard. UVXY, of course, has a natural long-term decay. It's decaying currently 0.8%. So I just show people based on the current snapshot right now when this email is sent, 1 day, 5 day, 21 day, this is kind of where we can expect the volatility ETPs to be. So that's a good one for option traders to get those expirations correct, figure out where they're going to set all their strikes. That's a pretty useful dashboard. This one is just general metrics. I personally like some of these, like the fast, medium, slow. I think they're excellent metrics. People can click on here and there's articles and videos. Same with the cash VIX term structure. It's one of my favorites. 5 links here. You can kind of get further education. And then every day, I think this is important as well, and I would encourage other people to do this as well, even if you're not a VTS member. But every day I calculate the actual beta factor of my entire portfolio compared to the S&P 500, just to know what my general market exposure is each and every day. So we've got 5 strategies currently in the VTS portfolio, and we can basically calculate, this is a rolling 5-year beta, but you could do 3 years, you could do straight back to an inception date, say 2005 or something like that. I like to do rolling periods because it does actually change over time. Sometimes asset classes, they ebb and flow with how strongly they move with the market, but this is obviously quite important to me. That's not overly important. If people have questions, they know where to find me. There's a blog every day, so you might want to check out my blogs. I sometimes write something that might be further education for your own trading. This day we just closed a butterfly trade, and I teased the live stream that didn't work, so that was awesome. Everybody went to that link and nobody actually got to see it. So again, apologies for that, but this is basically our portfolio here. Right now we've got 5 strategies with equal 20% weighting. You can see there's the Iron Condor strategy. That's basically what I'm going to talk about today. But if you want to see further, I like to show in one chart, basically, again, for the people who are just kind of doing a quick drive-by to see if there's any trades that day. You can see it here. You can see all 5 of them here, and that's a snapshot. But if you want to see more information, why the individual strategies are holding what they are holding, there's a trade dial for each one of them. So didn't change any positions here that day. We're holding the Dow Jones. This one's still holding real estate. This is a short volatility strategy. We use broken wing butterflies with the UVXY. There was a trade closing this day, but this is really what we're talking about. This is the Iron Condor strategy. So 20% allocation to this strategy. Now I'll circle back to this in 1 minute, but just so you can see the whole email, because there's more. It might look a little overwhelming at first, but trust me, you'll get used to seeing this. We do non-leveraged as well for people who don't feel comfortable. For example, the SSO is a 2 times S&P. I think it's perfectly safe when the volatility is below this threshold. I think it's fine to hold a little bit of leverage, but we never hold leverage positions in the high side. So you can see cash gold, we would never leverage gold. We would never leverage utilities. Obviously long volatility. This is an M4 to M7 product, which moves fairly slow. I never hold long volatility with leveraged ETFs. So the only time we hold leverage is in those low, safe equity positions. But if people don't want to, that's fine. They can just hold the regular ones, QQQ, DIA, things like that. And then lastly, there's just a bunch of information. These are all the live stream links. If something catches somebody's eye, they can maybe watch that. We do a lot of private live streams as well, and Q&As, and they're all time-stamped. And then trade frequency, correlations, all this information that people need. So Iron Condors. This is what today's live stream is about. So this Iron Condor strategy. I launched volatility trading strategies in January 2012. So we've actually been doing this a long time. What is that? 10 years and 7 months. And Iron Condors have been in the portfolio from the very beginning, all the way until sort of mid-late last year, where I just got too busy and I had to actually make a decision on how I'm actually going to handle my email inbox at the time. I've cleaned it all up now, so we can go back and we can do it. But Iron Condors have been in the portfolio for about 10 years. And so what I'm thinking about doing is actually, for people who do want some further education, and again, it's not required. You could just wait every day and take the position, like this trade right here. We've got an Iron Condor open. This was just a test to run people who have never seen one before. We did a practice one. But you could just take the trade, not learn anything, and just trust me that I know how to pick all the right strikes and all of that stuff. You don't have to actually do the course. But I always like to give additional value just to make sure that people feel that, wow, they're getting so much value for what they're paying for VTS. Not only do they get the portfolio, but they get all the additional education as well. So I'm going to put together an actual course for this Iron Condor strategy. And eventually I'll probably do the same thing for all of them, as you'll see in a minute. But essentially what we're talking about is, if you go to my, everybody's going to have their own login, and I'll show you an example of what these courses will eventually look like. And I'll probably make reference to this service. It's called Kajabi, because it's really awesome. It's a game changer for me. I'm really excited about it. But when you join VTS, you get a login, and you can get your welcome package. Everybody's going to get this. So essentially, if you want to see what one of these courses looks like, you'll start here. This course is just an introduction. You get this on the first day, and it just runs you through the basic welcome, the daily email structure that I just went through, most common questions people ask, all the individual strategy details, stuff like that. But this is really cool because you can log in. It'll tell you how many lessons there are. It tracks your progress. You can pick up where you left off. There's a button for the people who, I don't get to see it because I'm the administrator, but there's a button that you can just resume where you left off. It's really cool. So you can just go into each module. You can see I kind of left off there.
Two reasons why. Welcome to Volatility Trading Strategies, and thank you so much for signing up and joining the VTS community. I really do appreciate the support. I hope you have a fantastic experience over the next couple of weeks during your free trial, and I very much look forward to officially welcoming you soon.
All right, you get the idea. So really cool stuff. That's what the courses are. But even further than that, what I can do with this website is I can actually organize everything in courses rather than what I typically do, which is just links in the daily emails, which is fine. People know where to find it. But I think this course thing is actually much more interactive, and it's going to be way more fun for people. So I can organize courses around each strategy later on, and all of the content that I've done on each one of them can be put inside here. And then, of course, I've done about 200 YouTube videos at this point, 1,000 articles at this point. I've been doing this a very, very long time. Sometimes it's just totally overwhelming for people. So I could make a top 10, top 20 maybe. Just people can click in there and they can actually, track their progress and pick up where they left off. I can be more directive on where I think people would get the most information. And so there's the Iron Condor course. So I would basically start with something that looks like this. Now, it's not populated yet because, of course, there is no course yet. But I think it's going to be pretty cool. People will get their login information, and you can just go at your own speed. I'm planning to do, one video every several days, once a week. I don't know what speed people want to learn at, but eventually there's going to be a whole bunch of these. And what it will actually look like, this is the back end of the program for me. It's actually super, super easy to use. I'm very tech illiterate, as you probably noticed. I left most of you stranded yesterday on a link I couldn't find. When I find some type of service or website like this one's Kajabi again, it's just, for someone like me, this is a game changer. It's so easy to use. I can manage my website, my email list. Before I was using Wix for my website. I was using MailChimp to send the emails. I'm using a different thing to track my funnels. I have courses that I wanted to build. You could do that on Udemy or Thinkific. But all of them just do kind of one or two things. This thing puts it all in the same place for me, which is pretty awesome for a newbie like me. So if you want to see the course, what I've basically laid out here, my plan is to make this an Iron Condor course that is totally comprehensive. This isn't something where I'm essentially putting it together and giving you sort of half information and dangling it there. And then eventually I'm going to say, well, hey, if you want the really good stuff, you can upgrade to the gold package and you have to pay for that. It's not that. I'm basically making a course that if you go through the 25 videos, and eventually I'll go back to the top and do 25 more articles. I think videos first, because most people like video. Some people like to read, so I'm going to do basically 50 lessons. And point being that you could take that and you could just trade your own Iron Condor strategy. You wouldn't technically need my signals anymore. So it is a full comprehensive course. This is not something that I'm trying to get an add-on later on. I really am going to teach from every aspect I can think of. So if you want to go through some of these, just to give you a little teaser of what they're all talking about. First of all, I would talk about fundamentals, right? Obviously that's important. What is an Iron Condor? Why do we do it? How does it make this shape? How do you build it? Calls and puts put together a certain way, the Greeks and whatnot, like we could talk about the deltas and the thetas. That's all very important. I would do that all in the first video. But the rest of it is explaining everything else. Like there's a spreadsheet, for example. It might look something like, maybe not exactly like this, but this is an Iron Condor spreadsheet where you can just input all the things and every tab basically tells you what the tab is. If you don't understand what it is, you can just kind of highlight. Every one of them is already marked. And everything in blue is an input variable. Everything in gray is just a little formula that basically computes it all for you. And you can keep track of your trades. And I think this is very important to have a trade log so people can, once you get, say, 25 trades done, you're maybe not an expert, but you would know really what you're doing with Iron Condors. So that's the point of this. Not only to keep people engaged and understanding that it's a systematic process, isn't something that I don't encourage people to just wing it, like to just look at something and go, oh, this looks pretty good. I'm going to do such and such trade. I like people to really plan things out, make sure that it's systematic. Of course, there is some discretion, choosing strike prices I like to use based on deltas, but there's some discretion, but I do like people to be more systematic. So that would be a full lesson. Trade instructions, for example, like a lot of people don't understand when we say things like buy to open, sell to close, the 16 SEP 2022. What do all these things mean? I think that would be a full video on its own. Why do we sell them? I could talk all day long about why Iron Condors are awesome, so there'll be a video there. Why they perform best in high volatility. Again, it gets down to the fact that Iron Condors are a Vega negative trade, so it's probably better that you would open them during middle or high volatility. So there's a little bit of room for that Vega to bleed down and help your trade. If you're trying to open Iron Condors during very low volatility periods, if volatility spikes on you, you get hit twice. The delta hurts you, and of course the Vega hurts you as well. So full one there. Why wide wing is better? Sometimes people like to they don't like to look at it where the loss is bigger than the gain. We use stop losses, so that's totally irrelevant. But some people build these really narrow Iron Condors, and I'll explain why I personally think the really wide wing Iron Condors are by far more efficient and a much better risk-reward ratio. Stop losses, super important video. I would talk about that. Adjustments versus layers. This is important. Sometimes people will teach you this little hash line is where the price is today. Let's imagine that the price goes up here. If you Google how to do Iron Condor adjustments, what people will probably tell you is that you would close the unthreatened side, cash in your money, and move the whole thing over, or maybe roll the whole thing to the next monthly expiration, and that's what's considered adjustments. I personally don't find that efficient, and I don't actually like to do that. So I would talk about how I prefer to layer my trades instead. Iron Condor allocation sizing. It's not hard to figure out that allocation sizing is really one of the biggest issues in options trading, and it can make or break your success. If you get this trade and you're really good at selling Iron Condors, but your allocation is too light, it's really not going to make much of a dent in your overall portfolio, right? It's just going to be a very small benefit. But on the flip side, if you get that allocation a little bit too strong and you get a couple of bad trades in a row, it can really derail your portfolio. So I would want to go through the full details of the best risk-reward size based on the overall portfolio. Calendar options. Calendars, like I mentioned, low volatility isn't the best time to be trading Iron Condors. Calendars are actually much better, so we would go into that. calendars are a different trade. So if you look at this one, it's not actually the same looking trade. I'll just set up an calendar really quickly. You can see what I mean. It definitely needs a different stop loss because calendars look like this. So if you use the same stop loss for Iron Condors and calendars, you're going to be way over leveraged with something like this. So that deserves a full video. And then combining both of them, I used to call this strategy, for me, it was the Condor Calendar Strategy. For years, that's what we called it. But now, just because of, I suppose, this is a little bit of a clickbaity thing, but Iron Condors spelled out, it does just do better in Google searches. So it's no longer going to be the Condor Calendar Strategy. It's going to be the Iron Condor Strategy. And then when volatility is very low and it's not advantageous to open an Iron Condor, that's when we would get into the calendars. But that's just a little side note on why it's no longer, the name of the strategy no longer says calendars. But it definitely combines very well. And you have to know where that cutoff point is, right? You have to know how to filter volatility levels to make sure that you're maximizing the time you're in a condor versus a calendar. That's going to be a pretty important lesson there. Where did we leave off? Diversification into different asset classes. This would be where you get into the idea that, we're trading the SPY in this case, but there's nothing saying that you couldn't expand your portfolio and trade some of your assets in the SPY, the S&P, some in treasuries, some in gold, some in utilities and real estate. And you could actually build yourself a full diversified portfolio using just Iron Condors, rather than doing, say, what I do, where my Iron Condors are only 20% of my portfolio. If you didn't do any of these other things, you could still do a diversified portfolio within your calendar allocation. Now, I do that as well. When we take the trades, we will be taking some different asset classes. I see no reason why you shouldn't diversify this plus diversify the whole thing. This, diversify that, diversify this, each one of them on their own. And that's one way that you can do it. You can actually expand into many, many different asset classes. As long as there's liquidity in the options, you're good to go. A watch list, because of course there's differences in what we would be trading. There's the S&P 500, you could trade the SPY, which is an ETF. You could trade the SPX, which is a cash-settled index, and it's notionally probably 10 times the size of the SPY. So if you have a very large account, you would use the SPX. If you have a small account, but you like cash-settled and you don't like to deal with dividends, you could do the XSP, which is a minis S&P 500, all kinds of options. But I will actually give a full watch list so that, along with the Iron Condor thing, we can also have a watch list. And this is actually for a future course that I'm just going to share everything. Eventually, volatility strategies and earnings trades, and of course my famous VIX options portfolio. This is all planned, but for Iron Condor specifically, expanded watch list will be good too. And then when to find the best targets. When would you trade an Iron Condor? Of course, we've already talked about the volatility, but on this chart, is that a good entry? What about when the market is all out crashing? Is that a good entry, or should you wait for it to rebound a little bit? I could talk at length about that, so there'll be a video there. Ramping up the Iron Condor strategy. So let's say that you really like what I've taught you and you learn so much and you love it so much that you actually want to ramp it up. You want to take more than 2 or 3 trades. Currently in our portfolio, we take 2 positions at 5% allocation, and then that's based on net liquidation of the whole portfolio. But if you wanted to ramp it up, you could take many layers of trades. You could add 10 Iron Condors all at the same time, all on different assets, but much smaller allocations for each one of them. So 10 trades at 2% allocation or something like that. I'll give a spreadsheet explanation as well as details on how you could go about doing that. Again, on your own. This is not some type of upsell thing that later on I'll dangle the platinum course in front of you. It's nothing like that. And then of course we learn through examples, so I would plan several of these. There's probably every month or so I might add a new one if it's helpful to people. And then lastly, how this fits into the overall portfolio. And I would probably want to talk about the differences between my trend following strategies, because you might not be a VTS member forever. You might only be passing through for 4 or 5 months. People do that. People come through, they think, wow, this is great. I'll sign up for 6 months, I'll learn what I can, and then I'll move on. And that's fine. It's designed that way, that you can use it any way that you want. But I would want to tell people how they could match theirs to their own portfolio. So that will be a lesson as well. That'll be a really cool lesson. And then, like I said, I would probably go to the very top and I would go through it all top to bottom with articles as well, because I'm kind of old. I'm kind of the blog era where we used to read more than we watched videos. And so I can certainly understand why there might be some people out there that want to do that as well. But hopefully you can tell I'm actually pretty excited about the prospects of this new Kajabi. I really, really like it. So just a complete side note, but if anybody out there, if you have a skill, I don't care what it is, if you're a great chef or you're good at gardening or you're an English teacher, whatever it is, I think, using something like that, if you're intimidated by it, there is technology out there that can help out, and it makes it so easy. So not only do you owe it to yourself to put together a course, sharing it with the world, but you owe it to other people as well. I mean, they can decide later on if it's worth the money for them or not. I mean, we're all adults, right? You're not forcing anything down their throat. But I do think that people could really benefit from actively putting your expertise into an organized course. And again, don't mean to keep harping on it, but if you're anything like me, it seems like a really daunting task until you realize, wow, there are things out there that you can really do this. You can just, add a new lesson. I don't know, Iron Condors on Bitcoin. Let's see if there's a Bitcoin ETF on our horizon in the future. And you basically just do that. You just make the lesson, go in there, put video, upload the file, and there you go. It packs it into the course for you. So on the front end, the whole thing ends up looking like a really polished course. It looks like I, did a pretty good job here. All I really did was just switch out the picture, changed a bunch of the text. It's going to organize it all for me. So don't be too intimidated by this. You really can do it. And then of course you can track everything. There's sales funnels. I don't know any of this stuff, but if a guy like me can figure it out, you can certainly figure it out as well. So the other benefit to doing that for yourself is that just the amount of things you'll learn along the way. You'll learn how to do videos, you'll learn how to edit, you'll learn how to present things, and you learn how to build a website. It's pretty cool. So even if nobody buys your course, all you in the chat section, I know you've got some type of skill out there. I would encourage you to put something together. It might serve you well in the future. So if you want to use Kajabi, there is a link in the description. It gives you a 30-day trial instead of, if you go on the website, it's a 14-day trial. You can go ahead and check that out. But I fully endorse this thing because it really changed the way that I'm going to organize my content going forward. So that is the course that I have put together. Probably right now it's 25 videos, but I would imagine it's going to expand in the future. Every time I do one video, it seems like I get another idea for another video. So that's what it'll be. So if anybody is interested, again, this isn't really a sales pitch. This is mostly directed at the current VTS community because they're going to get the free course and we're going to start next week. So I just wanted to kind of break it down on somewhere that they didn't tune in live, they can reference later on. But if you do want to actually participate in this course, if you go to my website and you go to the subscribe tab, you can just sign up for either the monthly or the annual. And like I said, some people are just passing through. Maybe you are only intending to do the Iron Condors course, stay for 2 or 3 months, and then move on to something else. Other people might want the discount. They might stick around for a year or two. I have people who have been following me since 2010. I mean, honestly, I've got a few real hardcore loyals in the community as well. But however you want to use it, the free trial is there. The Iron Condor course is starting, and feel free to participate. You're always invited. Or, like I said, a lot of what I do is totally free. So don't feel like just to follow me, you have to pay money. You certainly don't. All right. So that's it. I wanted to do that yesterday, of course, but I didn't know what I was doing. I let a lot of you down. So there it is. Now I will open it up to questions. Of course, you can ask about what I just presented there, or you can just fire away. You can ask me anything you want. Do I have a thing about my interests? Oh, that's gone. Anyway, yeah, ask anything you want. First question. Could you give us some light on what is happening with VXX? Any news regarding fixing it? VXX is an absolute mess. They still have not fixed it. So if we want to see how they're doing, VXX minus VXX.IV. VXX is the NAV value, the value the ETF is actually trading. And then the VXX.IV, that's the ticker symbol for what's called the intraday indicative value of the ETFs. And all of the ETFs have indicative values. And you can see it's actually supposed to be the same price, right? More or less, right? They are actively managed throughout the day, but you really should see that it is basically flatlining. These are bad prints. It didn't actually fluctuate like that. It's supposed to be basically flatlining. But you can see Barclays broke this thing by not issuing new shares. Their share creation went dead, and it's been a nightmare since. So it looks like it's kind of marginally fixed. It's really not. It's just people are so uninterested in VXX, they've just moved on. So it is not fixed yet. It's not functioning smoothly. And the gap between the NAV and the indicative is expanding again. I've largely just dismissed it. I haven't even kept up to date on what's going on. There's lawsuits being threatened. There's rescission offers that are really confusing and clouding the situation. I don't know. The volume is incredibly low these days. I think most people have given up. And I don't even know if it's worth it for them to fix it at this point, because its name is so tarnished that even if they did get it functioning again, I don't know how many people would go back and use it, to be honest. So it's not fixed. I would recommend people don't touch it for any trading, not speculating, because you don't know how people are going to view it, and also certainly not quant trading, because you have to actually know that it's tracking its NAV value. And if it's not, if it's $2 off, that's not nothing. So it's dead. VXX is dead. And until they fix it, and then it goes through a long period of time being fixed, and the volume comes back, maybe we'll give it another chance in the future. But right now, it's a dead product. That's all I can really say. About a month ago, I just stopped reading all the news updates. I don't care anymore. We've moved on to UVXY, and my long volatility positions never really used VXX anyway. I like to use the M4 to M7, the VIXM product. So that's my suggestion. If you are going to trade it, just know that you're trading something that is technically not functioning how it's supposed to. So be careful. Is this a full free course? Well, kind of. It's free if you're a VTS community member. I don't know if that counts as free, but of course, as you saw, the VTS community isn't just this course. Of course, that's a tiny percentage of what we do. This is just an add-on that I thought would be really cool, and just value added to the community. But there's many reasons. I don't want to turn this into a marketing campaign, but I think there's several reasons to join, and as a benefit of that, you would get the course if you joined. Let's leave it at that. I'm always I don't like to talk about money and subscriptions and stuff like that, but it is what it is. Sometimes you have to inform people of the work that you've put together. So how is the VXX.IV or any other indication calculated on platforms like Yahoo? How it's calculated? I'm not sure that's even important. I mean, what it means is important. Basically, these volatility ETFs, they trade like an ETF. And of course, that's a problem if it has to track something that's an underlying formula, right? The VXX is technically just the VX30 roll yield being represented, over time. And so how does that work? If it's gonna work on regular supply and demand, then it's going to just trade based on people buying and selling it, but then it's not going to track the formula. So there's basically these entities or people called authorized participants that are authorized through Barclays to actually buy and sell the shares that are being created and removed, and they're able to bring it in line with what the formula should be. So it happens very quickly, and of course they're very well incentivized. That's how they make their money. It works really well most of the time. If you look at some of the other ones, they track quite well, like the UVXY.IV. Again, these are bad prints, but it happens so fast that it basically just flatlines over time. And so that's how they keep these things in line. It's not, sometimes, and I've said it as well. You can see here, this is only reflecting because there was a reverse split. It didn't actually break. It's just the calculation no longer visually shows correctly when there's a reverse split. But you can see it's supposed to just flatline. Now, I sometimes say, volatility ETPs don't trade based on supply and demand. The number of people buying and selling the product has no bearing on the price of the ETF. And that is technically true when you drag it past a few minutes. But moment to moment, of course, it is an ETF. So you need these authorized participants actively getting that indicative value into the NAV value, or the NAV value to the indicative value. I think that's the important thing to focus on. How they actually calculate it on Yahoo, I don't know. I'm not sure that that even matters. They are able to do it. I mean, it's a pretty foundational thing with respect to ETFs, especially the volatility ETFs that are not supposed to trade based on supply and demand. Any opportunity in GDX? I don't really trade GDX. I don't really trade the miners because mostly we are looking for things that are more stable. If you look at the gold miners, the correlation between the GLD and the GDX is pretty wild. Like if it goes on a good run, it can rapidly outpace the GLD. And if it goes on a bad run, it can significantly underperform. And then of course you could also, what is it? The GDXJ? Yeah, the junior miner. This is even worse, right? So this one will be even worse. I typically don't trade them. I'm not looking for things that move that wildly. When I'm in the gold, I'm only in gold because of the stability and the fact that it's better than equities when the stock market is crashing. When I buy gold, it's not because I'm bullish on gold. It's because I want to park my capital in something that isn't equities. Basically, it's a safety position. So if I take that GLD position and I turn it into the gold miners or the gold junior miners, now you're talking about something that's much more correlated to the equities market, and it no longer serves the purpose that I want. So I'm not necessarily saying you can't or shouldn't. It's just the only place in my portfolio that I ever actually hold the GLD or gold is for a parking spot safety. And so GDX is significantly worse than GLD for that point. But if you're looking for something that moves a lot, then yeah, there you found your thing. Doesn't serve any purpose for my portfolio. Okay, I work at a bank and I showed your videos to my coworkers, but they think you are scamming and that there will always be some that outperform the S&P for 10 years only to underperform the next 10. Well, I definitely agree with that. The second part, not the scam part. I don't think anybody who seriously watches my work thinks that I'm a scammer. But I totally agree 100% with that second part. It's basically just a statistical thing. Like it's very hard to beat the S&P, right? So beating it in 1 year isn't overly difficult. There's probably, maybe even the majority of people beat the S&P over a 1 year period. Over 2 years, certain people fall off. Over 5 years, more people fall off. When you stretch it out to 10 years, now you're talking about something that's really probably quite a good portfolio. To beat the S&P for 10 years is not easy. There aren't that many things that can do that. And then to go, like you're saying, beyond 10 years to 15 to 20 to 30, now you're talking about just the all-star investors of the world. So I'm 17 years into my career. In order to be considered, one of the all-stars, not there yet. I mean, you talk about the big names. Everybody throws out Warren Buffett. I'm not literally trying to compare to Warren Buffett, but I mean, you're talking about 50 years, right? 60, what is he, 90 years old? And he started when, 60-year investing career. And he's gone through many, many periods, extended periods where he underperformed the S&P. That is going to happen. All managers are going to have that. You're never going to find a single person who just year after year, and I know somebody's going to say, oh, what about Renaissance or, something. But, well, if you look at all the funds, there's really only one of them that's really good. But anyway, beside the point, I agree with that. I just, I can't do anything about people who would think that I'm a scammer. The only thing that I would say about that is probably you haven't given a serious look at my work. And I understand that I am in a subscription business, and the vast majority of people in my field are scammers. So it's very easy to have a knee-jerk reaction that, oh, all of them are. Like there's so many bad ones that you might as well just throw them all in the same boat. I'm fine with that. If you're intrigued by my work and you think I'm a scammer, watch more. Try to find the points that I'm scamming, and you will do one of two things. You will either prove yourself right, that I am eventually a scammer, and if you watch enough of my videos, you're going to see me contradicting myself, and you're, oh, he said that 2 years ago, and now he's doing this, and you're going to either prove yourself right, or you're going to get to a point where you're like, you know what, this is actually different. I was wrong about this one. He's actually really trying to help people. It's not up to me to decide. It's up to the audience to decide. So all I would ask, if somebody wants to call me a scammer, give me a chance. Watch enough before you make that judgment. And I suspect it'll be the second one. I suspect you'll think, well, maybe I jumped the gun. But if you do prove yourself and it's the first one, that's what due diligence is. And you should do due diligence on everybody. So myself included. Seriously. Consume as much as you can of my work and try to find the spots that you think I'm saying something that's not true. Could 300% stop loss very good when I use wide wings? I'm not sure what you mean there, 300% stop loss. I use a 50% stop loss and stop gain on my Iron Condors. So what that means is this trade, I opened it, I believe, for $1.17. If memory, no, I don't even go by memory. $1.15? What did I get it for? $1.20. So I got this one for $1.20. So 60 cents. When this either hits, and even I can show you the spreadsheet because it's calculated already. Remember, gray cells are just calculated for you. So the 50% stop loss is basically the stop gain is if it hits 60. That means that from the $1.20, it goes down to 60, and I keep that half, that 60 cents. The stop loss is, you can see, times 1.5. So if it goes from 120 to 180, I have lost 60 cents. So I'm looking to either make 60 or lose 60. And based on the fact that there's 27, no, that trade is 15 contracts, I believe. Where are you? 32. Oh, I know what happened. Oh, this is just the test one. Sorry about that. I got confused there. But yeah, it's listed here. So I'm just looking to make and lose the same amount of money. So even though I can lose a lot more than I can make, because it's a wide wing condor, this thing is going to move so slowly that I can stop loss or stop gain out on my own schedule. I'm not going to get shocked by something. If you do the really narrow wings, the delta and the gamma are very sensitive, and you can actually get shocked well past your stop loss in one day. But that's why I do the wide wings, to avoid that. Teaser for whatever video number 17 I had planned, but I'll go into way more detail, of course, but that's essentially why. But yeah, I'm just looking for a 50% stop loss or stop gain. When this trade makes enough or loses enough, I'm out. And then it's just a matter of trying to get more winners than losers. If you're doing a 50-50 on both sides, then I just need to make sure that my entries are well timed and well thought out, and I get more winners than losers. So I don't know what you mean by 300%. That is, I don't even know how that would work out. 300% of the premium, 300% of, I do not know. So try again, clarify down below. There's still some time here. Maybe I'll get to the follow-up for that, but that's what I would say. Can you explain the difference between beta and beta-weighted delta to gauge portfolio relation to S&P? Beta factor is just, I'm not exactly sure about the semantics you're using there, but beta is just measuring the direction and magnitude of one security in relation to another. So the QLD, for example, is a 2 times NASDAQ ETF. Rolling 5-year beta is 2.22, which means it's not an exact science. Doesn't mean that every single day it does this, but over time, if the S&P moves 1%, the QLD will typically go up 2.2%. And if it goes down 1%, it'll drop 2.2%. So delta, beta-weighted delta, I mean, it's basically the same thing, right? Is it just a semantics game, or am I missing something? Sometimes on live streams, some obvious questions go over your head because you can't really process the language in the moment, but I'm not really sure what you mean by that one. I just calculate my beta. You could do it on options as well, and in that respect, you'd probably use the word delta somewhere in there because, of course, an ETF is a 1 delta product, but sorry, I just delta to the S&P 500. Just want to know how exposed I am in general. Again, it's not an exact thing. Doesn't mean that on Monday, if the S&P does that, then it will necessarily move my portfolio 0.86, but close enough. Over days and weeks and certainly months, it's pretty accurate. What is your rationale for selling Iron Condor in a downtrending market with such unpredictable and violent spikes in IV? So essentially, it doesn't matter because you're using volatility in your favor. So for example, because the options market is fairly efficient, if you were to sell an Iron Condor up here, the way that the options are priced, the wings would be quite a bit more narrow because, of course, the premium is going to be lower, volatility is lower, and you would be facing a condor that is narrower, reflecting the fact that the markets are not moving around very much. If you open an Iron Condor down here after a 15 to 20% stock market crash, you might think, well, I don't want to open one here because what if the market goes screaming back upwards? That is partially covered by the fact that you're selling such high vega right now that these wings are stretched out an awful lot. I actually have an article on the website right now. I think I wrote it back almost 8-9 years ago. 101, why I prefer 90%. Let me see. I think this might be it. I hope I guessed right. On live streams, sometimes you don't guess right. Yeah, like this is, no, that's not it. Sorry, give me 1 second. I know it's a series called 101. Perform better in higher volatility. I mean, this wasn't written in 2017. You can see these charts are all the way back, 2013, I believe. So this is my point. So when you're selling an Iron Condor here, Thinkorswim doesn't even look like this anymore, so ignore that. But volatility of 18%, your wings aren't going to be overly wide, right? So the width of the trade, I believe I pointed it out somewhere, 9% up and 9% down is what the wings represent. If you sell an Iron Condor during mid-volatility, 33% volatility, your wings spread out to 16% up and 16% down. If you sell an Iron Condor during the heart of a massive crisis with 64% volatility, this was November 2008, you can sell an Iron Condor with wings so wide, 35% up and 35% down. So this thing would stretch out so far that it would look like this, right? And that's the insulation that you get. So with your question, why would you do it now? I see your point, but you're forgetting the fact that the higher volatility is, the wider it gets and the bigger margin for error you actually end up getting. So higher volatility is the more favorable environment. I know it sometimes seems counterproductive because people think you sell an Iron Condor, you want the market not to move. And what better way to sell an Iron Condor than in a market that isn't moving, right? Isn't that fantastic? It's volatility's low, the market's super stable. Let's sell an Iron Condor. What a great trade. Well, it's not at all, because if the market does decide to start moving, you only get a tiny margin for error before you get stop lossed out. If you sell it when the market's already panicking, those wings are incredibly wide, and it's very unlikely that that Iron Condor will be threatened. You can see this one that we traded. I opened this at a price. This is why you record your trades, so you can go back and you can actually study from them. But I opened it when it was 384.96. So I opened the trade when it was right here, somewhere, let's say here. And recently it went all the way over to here. It went pretty high, almost to 400, right? What did the SPY actually end up doing? Yeah, I remember it was just about to clear 400. Intraday it did. But my trade was still up money because I sold this when the market was low. I sold this at a point when the S&P 500 was like down here. So I don't really care if it storms up because my wings are so wide. That's the point. I can't tell anybody what to do, what not to do. I tend not to do that with people. I just give my opinions, but I would be very wary about selling volatility when it's low. Selling Iron Condors when volatility is low, because like you said, that's when it's unpredictable. That's when the violent spikes are actually going to hurt you the most. When volatility is already high, a volatility spike doesn't really do much to you. There's lots of ways to either still make money or to stop loss out at a reasonable speed. Are Iron Condors a good strategy to use on something like SPY, SPX during such events like Fed meetings, announcements, binary events, basically? I would say yes, for all the same reasons I just went over. That as long as you're doing them correctly, as long as you're doing wide body, long distance to expiration, you're going to be fine. If you were to sell an Iron Condor, we've got a Fed meeting next week. If you were to do the monthly cycle, the 27 days to expiration, this trade will have very sensitive delta and gamma. And if that binary event goes badly and the market reacts, let's say it has a 2 or 3% move, you very well could wind up with a trade that stop losses out in a single day. But if you widen the wings, if you increase the distance to expiration, and if you open the correct Iron Condor, then it can be insulated against those binary events. So you can either not trade them, that's always an option, or you can trade something that moves very slowly, and then you don't actually get killed by it. Kind of the same reason why when I want to go long volatility, I don't just buy the UVXY. That's a crazy trade. What if I'm wrong? The UVXY is 1.5 leveraged. If I'm wrong, it's going to hurt badly. I always think as a trader, figure out what happens if you're wrong first, then figure out what happens if you're right. But what most people end up doing is, here's how much money I can make, not really paying attention to how much you can lose. So I always default to slow-moving products. VIXM for long volatility, wide-body Iron Condors, long-dated calendars, things like that. And then I can just hold my portfolio through binary events, and not saying that it always works out awesome. Sometimes you do get stopped out, but you don't ever get killed. And that's kind of the point of trading, is always live to fight another day. So when do you add layers? I mean, we're basically going through, we've covered 10% of the course today. No, I'm kidding. It's going to be much more detailed than this. When do you layer? Well, like I said, right now, just while I'm sort of teaching the community, a lot of people in the community have seen these already, so it won't take long before they refresh their memory. But right now we have spaces for 2. Now, what I would typically do, you can see in the spreadsheet, I also said 2, but actually, if you wanted to trade them correctly, you'd want to do 3 or 4 at smaller allocation sizes. So we will probably in the future add a few more things. And essentially, you just don't want to be taking redundant trades. So even in the spreadsheet, I put basically a 4% up and down threshold where, for example, if you're trading an Iron Condor here, and this is for the September cycle, there would be no, if the price a week or 2 later was still in this range, that's a very loud supercar outside. there would be no point in just doubling up another trade. So what I typically do is I either trade a future expiration. So I might start layering the October. I might trade a different asset class entirely. That might be a different layer. Or I would wait until it moves significantly away from where I originally opened the trade. Why double up on something for no reason, right? That's how come I layer the trades. But you can imagine what would start happening if you start layering trades staggered by several days, spread out over distances that the S&P 500 has actually moved, and then you add in different asset classes, and then you add in 5 or 6 positions at smaller allocations. All of a sudden now you've got a very well diversified portfolio constructed entirely of several layers of Iron Condors. You could do, the standard maybe 50% stocks, 30% bonds, 20% gold, some type of standard buy and hold portfolio. You could do something that does way better than that portfolio with just Iron Condors. Instead of holding 50% stocks, you layer your SPY Iron Condors. Staggered out prices, staggered out different expiration cycles. Instead of just doing this and holding bonds, you open TLT Iron Condors. Again, spread out by 15 days or 10 days each and 5% moves in between them. All of a sudden, you've got a great portfolio, and it makes the buy and hold thing look pretty stupid. So that's what I mean by layering trades. I like to get it so no single trade can ever derail your portfolio. You always want to have very small things working in your favor, and you can afford to lose a few of them. A lot of people, when they trade Iron Condors, they're basically like, okay, I trade one big one every month, right? A large Iron Condor. And some people out there, gurus, will even tell you, you can make 8% a month. It's an income trade. It's basically a monthly dividend. I mean, it's just ludicrous what people teach these days. But no, that is not at all how you succeed trading. You want to have small trades, multiple assets, multiple time frames, spread out over different prices, all of that stuff working in your favor. Okay. Do you have any data on the results of automatically opening a 10 to 14 days at the money put broken wing butterfly on UVXY? Could you elaborate on this? Thank you very much. Really appreciate you. I don't have any data other than blind selling of premium on a calendar schedule doesn't work. It just doesn't. How could I show you that with a representation? I don't even know if they still publish this. CNDR. How far back is this going to go? No, it doesn't go back. I have it in one of my spreadsheets, but you know me, my spreadsheet will crash this live stream. So I was going to show you the Iron Condor. Basically, it's just a calendar schedule premium selling index. And it used to do very well in the 90s and the early 2000s. But right around 2005, it just flatlines and it's actually going down. Selling blind premium hasn't worked in 10, 15 years. So your idea of doing this, while it seems to make some sense, and some people might be able to talk themselves into it, there's no reason why that would perform well, because the options market is fairly efficient, right? There is really no arbitrage opportunities, and there is no selling vols just definitely better than buying vol. That was 20 years ago. These days, it's much more sophisticated, especially in the UVXY. You're talking about a derivative of a derivative of a derivative. So you're getting to a point where you're competing against people who, they know everything you know. They know everything I know. They know the UVXY decays over time. They know about the VX30 roll yield. They know about all of this. So there's no reason that you just do this on a cycle that would work. I would expect your profit long term to be about 0% minus trade fees, give or take. So what we do is we time the entries and exits. We want to make sure that we're entering the trades at the right time. And you can increase your odds. It's basically about finding small edges and then adding all up your edges as you go. A little 1 or 2% edge there and a 3% edge there and a psychological edge, and you're systematic and you're very disciplined, so that's an edge, and you understand roll yield, so that's an edge, and your timing and how it works into the rest of your portfolio, that's an edge. And you add up 6 or 7 little edges, and leads to a long-term profit. But doing something like this, I'm sorry, it's just, eventually the winners and losers will cancel each other out because the options market is efficient. It really is. You just have to assume that, I remember 2013, 14, 15, kind of the early days of the short vol trade. I can't tell you how many times I had to answer questions about this. People saying, well, the VXX goes down, right? So let's just buy put options. Well, I mean, what a no-brainer. It's an ATM machine. Hundreds of times I had to explain why that doesn't work. I mean, obviously you have to assume that everybody trading these products, they already know it decays. So it's priced into the options. It would be insane if it wasn't priced in. It would literally be free money, and that doesn't exist. So, I could tell you that the futures are in contango 84% of the time, and the UVXY decays most of its life cycle. So if the options don't price that in, shouldn't I be a trillionaire at this point? Unfortunately, no, because everybody and their dog already knows that contango and backwardation and all of these things. So the options already know that. Why does Justin Trudeau have a Julius Caesar haircut now? I don't know. I am Canadian, but I pay zero attention to Canadian politics. I'm fully aware that he is still our prime minister, but if he wasn't, if somehow we had an election, and the Canadian election cycle is not like the US one, it's actually kind of weird, but if he wasn't the prime minister, the only way I would know that is if somebody on my live stream told me, because I just don't care at all. I've heard bad things about Trudeau. I hear the chatter, but I don't know his policies. I don't know anything. I haven't lived in Canada in over 20 years, so I don't care what, I don't care about politics in general. I feel like they're all on the same team. I don't care who his opponent is. They're friends behind the scenes, I guarantee it. People used to get mad at me when I said, Hillary Clinton and Donald Trump are probably pretty good friends behind the scenes, or, Mitch McConnell and Chuck Schumer, they probably hang out together. They probably golf together. I mean, they're all on the same team. So I just don't follow politics at all. I just assume they're all out to get us. I just make the natural assumption that, let's say I was a staunch Democrat. I'm not, by the way, but let's say that I was. I have more in common with a hardcore Republican voter than either one of us do with the leader of our own party. So this whole vitriol, and it doesn't make any sense. So that's a whole long rant of saying I have no idea, but I'm going to go ahead and Google that later because that sounds funny. He does have a history of some awfully strange photos and costumes, and kind of a weird guy. Yeah, I don't know. Do whatever he wants. I heard that 300% of the premium should be good because it would happen very rare, and most of the time the 50% take profit would work out. So again, I don't know what you mean by 300% because there's only 100% of premium collected. I bail out of the trade at 50%. So 300%, you can't bail out at 300. You have to bail out at some point from 0 to 100. But one of the reasons that I don't hang on to my trades, let's say that this trade was profitable and the S&P 500 was right here, dead center. Make sure I'm screen sharing. Okay, good. So the S&P 500 is absolutely dead center. I've captured 50% of my profit. I guarantee you there will be people saying, well, how come you don't just hang out in the trade for another month and you'll get the full profit, right? You can just wait and you can get all of this, the $3,100. You can see it down here. $3,100 instead of $1,650. Why wouldn't you do that? Well, the reason that I don't do that is opportunity cost. To stay in a trade requires an additional month. This cycle still has 55 days to go. If the SPY cooperates and it remains in this sort of center range for another, 2 weeks, I will probably stop gain out and take my half profit. But in order to get the full profit, I'm going to have to hang out in this thing for the whole 55 days because the curve of theta decay, this is very scientific, I know, but the theta decay kind of looks like this, and right around 40 days, it starts to really accelerate, and the last 10 days, it gets steep. So if you want the full profit, you have to wait the full 55 days, or at least 50 of the 55 days. I would rather take my 50%, move that capital to a brand new trade that again resets the thing and it goes back to 100. And I'd rather get 50% each time and just scalp 50% over 2 or 3 weeks rather than attempting to get 100% over 8 weeks. It's just as far as opportunity cost goes, leaving money tied up into a trade that has already captured half of its premium doesn't make a whole lot of sense. Again, this is one of those trading mindsets. It depends on how you look at something. How much can I potentially make, or how much can I potentially lose? I always default to, let's cover the bases of not doing stupid things, and let's worry about making the big money later. Like, the profit will add up over time. But I don't want to leave my money tied up in something that I'm going to have to wait another month to just get the last 50%. Doesn't make sense. I like to hit them all many, many layers, as I talked about, and just scalp them that way. Again, more winners than losers is all I'm really looking for. If you set it up 50-50, the actual scale and size and the picture of it, like I said, some people freak out. They'll be like, wow, you could lose $10,000 and you can only make $3,000. What a terrible trade. Well, no, because I'm using a 50-50 stop gain, stop loss. I don't care what this looks like at expiration because I'm going to close this trade more than a month before it expires. I don't care what this looks like over here. It'll never get there. You can see the pink line. If the market had a Black Monday crash, I'm not going to lose $10,000. It's going to go, let me see. Let's see what happens if Black Monday happens on this Monday. 395 times 0.78, 308. So it's going to go down to about here. If Black Monday happens, I'm going to lose about $6,500. So I would only have to have about 3 winning trades to cover the worst event in the last 30 years. That's why we do this. But if you open a short-dated contract, if you open a narrow wing contract, if you're waiting and waiting and waiting till the last possible minute, like you're saying, to capture more of your premium, your gamma is growing with every day that it gets closer to expiration. And we call that dancing on the gamma knife edge, because if you get close to that expiration, it is true you can make more money, but any adverse moves in the underlying market are going to shock your trade, and you could go from being a really comfortable winner to a loser in one day. That can't happen the way that I trade. Again, I'm always mindful of the bad things that can happen first, and then focus on some of the good things that can happen later. So I suspect, again, I'm thrown by this 300 number you keep throwing out there, but I suspect that was your point, that why wouldn't you wait a little bit longer? That's why. Opportunity cost is a real penalty in option trading. You want to manage your capital very efficiently. How much upside or downside would you give the Iron Condor in 45 days to expiration and 15.5 delta? So I don't tend to, if you mean 15 on one side and 5 on the other, I don't lopside my trades that much. Sometimes I'll pick up a little bit extra delta on the put side, maybe a 14 delta and then a 12 on the call side, but I like them to be fairly even. Again, options are priced quite efficiently, so delta is another way of viewing probability. There's no reason to lopside your deltas unless you have like a gut prediction about the underlying market, which I tend to try to avoid. I'd rather just layer a bunch of neutral trades rather than that. But how much upside or downside? It would be based on the delta. So a 15 delta on either side is going to be what we'd call a 70% Iron Condor. If it's a super high volatility market, those wings could be very wide. If it's a low volatility market, those wings would be much narrower. Even though they're both 15 delta trades, both 45 days to expiration trades, it's going to depend on the premium. And premium is priced based on all of the, the fundamentals of the situation. So it's like that article. Maybe you should read these. These are super old, but and I'll probably update them eventually. But big difference between an Iron Condor with 35% up and down on the pricing versus one that has, what did we say, 8 or was it 9? 9% up, down. Big differences. This is bugging me. I can't remember when I wrote these. So I want to see it. Can't see it. Long time ago. But there's a 6-part Iron Condor series on the website. Don't read that. I should delete that from the website, to be honest, because I'm going to do that 25-part course that's going to be way better than anything I've done on the website. Okay. Iron Condors are short Vega. You earn with short Vega when realized vol is less than IV, meaning you want to sell Iron Condors at the time that volatility of IV will decline in the future. Sounds right. That's why you want to sell Iron Condors when vol is high. Sounds correct. Because when vol is high, you're getting paid fair price or vol will decline, which normally happens. Correct. If it's already high, then that would be a good assumption. Selling Iron Condors when volatility is stable is not great trade because you won't be getting paid the risk of the potential spike. Again, correct. I mean, do you want to co-write the course that we're doing? It sounds like, I don't know if you're talking to somebody else, but yeah, like agree on all points. Stability equals low IV by definition. Correct again. This guy's on fire. Thanks, Vincent. Yeah, I agree on all points. That's exactly right. Essentially, you want to view it that, again, trader's mindset, what could go wrong? Let's cover that first and then figure out the profit later. What can go wrong if you sell an Iron Condor when volatility is already very high? Not much. The wings are very wide. Volatility can't really go from high to super ridiculous high. It just doesn't work that way. There is no, I mean, it might go up a little bit, but it's already up, and up might go up more, but not shock. Well, what can go wrong if IV is 15%? In a day or two, that could change radically. You get a volpocalypse event, and not only has your trade stopped out, but it's blown way past your 50% stop loss. So as far as what can go wrong, sell volatility when it's high, buy volatility when it's low. That is the basic thing here. Getting back to that point where somebody said, what would happen if you just layered UVXY trades over and over on a calendar schedule? Well, this used to work 20 years ago because the options market wasn't very sophisticated, and selling, because the volatility risk premium was so much higher back then, IV was reliably way higher than the realized vol. It's not the case anymore. So these days, there is no inherent selling is better than buying. You'll see that on Twitter still. You'll still see people say the smart money sells options, the dumb money buys options. That is not the case. The smart money sells volatility when it's high, and it buys volatility when it's low, right? Sell things when they're expensive, buy them when they're cheap. That is the smart money. It's no longer the case that you just blindly sell vol. So everything that Vincent said was true. Those are the reasons why. Has to do with the probability of your trade having more margin for error, being insulated from those surprise moves that are going to happen. All of us as traders, we're going to have very bad days, bad weeks, bad months, and yes, bad years. So just do the right thing over and over again and layer them and keep them small and do 10 of them at the same time, and over a 10-year career, it will work out. That's my philosophy. Law of large numbers. Take as many high probability trades as you possibly can, do more of what works, less of what doesn't, and look at your profit 10 years later. You'll be happy where you end up. That's why I thought iron flies or broken butterflies were better, because it was more profitable due to it being, well, it's, again, this is a sell the advantageous, buy the non-advantageous. So we've got a metric here called the VIX minus VOLI residual. So the VIX index is a measurement of S&P 500 options activity based on an entire strip of options. So it's going to be based on pretty much every strike 30 days out, but an entire strip of options. So there's a way that they will use the 30-day options, and it's basically all the strikes. The VOLI index is very similar, except the VOLI uses only at-the-money options on the SPY. So the VIX uses all strikes of the S&P, and the VOLI uses at the money on the SPY. So if you take the differential between these two metrics, what are you measuring? You're measuring how much out of the money activity traders are pricing in, right? So if this number is very high, it means that out of the money premium is actually relatively expensive. So what would you do if that was the case? If you have out of the money premium being very high, you would want to sell something like a strangle, wouldn't you? You want to sell where it's expensive. So what you would do is you would sell a strangle, something like this. And you would increase the wings to the point, I don't know, I'm not doing this, I'm doing this all on the fly, but let's say you did something like this, because you know that the out of money premium is paying more right now. So if the VIX minus VOLI residual is really high, you might be more beneficial to trade something like this. Whereas if that volatility differential is very low, it means at the money premium is paying quite a bit of money right now. So sell where the premium is high, sell a straddle. These trades are materially the same, right? They're basically the same thing, other than this person is selling the out of the money strikes and this person is selling the at the money strikes. So you'd want to make sure that the skew and where you're selling is giving you the most bang for your buck. That gets back to the point where adding up several really small edges definitely in the future leads to good return. If you can always sell the slightly more expensive strikes and you consistently do that over time, you might increase your long-term rate of return by 2 or 3%. If you reduce your trade fees just by a little bit, you might increase your long-term rate of return by 1%. If you understand the volatility metrics, you might get an extra 2%. And all of a sudden, you're not doing a whole lot different than everybody else online is doing, except you have slight edges here and there that add up. So just a totally random, how long have we been going? Hour 16. I haven't done a golf analogy yet, so here you go. I used to be a professional golfer, another lifetime, years ago. And the thing about pro golf is there's a lot of people who golf. It's a very competitive sport because so many people play, right? It's just, millions of people around the world. It's one of the most played sports. And so you get to things like high-level amateur golf and college golf, and everybody's more or less the same. So this is where I started thinking about the concept. What I used to call it when I was practicing my golf was trying to 1+1 people, 1.1 people, so what I used to call it. And basically, off the tee, line up 100 top college players, everybody looks the same. Everybody has a 1. So if you have 10 categories in golf, driving, irons, chipping, bunker play, sand play, mental game, course management, nutrition, whatever it is, 10 categories. You can't really beat somebody based on one category. You can't just, oh my God, I'm so good off the tee that I'm just going to win all the tournaments. It doesn't work that way. Everybody can drive the golf ball. Everybody can putt. Everybody can get up and down from the bunker. So the only thing that I can do is be 0.1 better than that guy and that competition off the tee. And I can only be 0.1 better on the greens than these people because they're very good too, and they train really well. So I just have to add up my 1.1s, as many of those as I can get. And that guy might be a 10. He might be good at everything because we're all good at everything. But I'm 1.1ing those people, so I'm actually 10.5 or 11. It's just finding those little edges over my competition. And option trading is the same thing. You just try to 1.1 your competition because there's no way you're going to do something, like one thing in your option trading that's going to revolutionize everything and you're just going to crush everybody and you're going to turn your 5% return into 20. It doesn't work that way. You have to 1.1 everything. So you have to know all aspects of these trades. That's why the 25-part course, if I teach you some little thing in each one of those courses that just gives you a 0.1, all of a sudden at the end, you get to 1.1 your competition, and now your rate of return might go from 5 or 10 up to 20 or higher. Not because you just dominated one thing, because you're slightly better at 10 different things than your competition. So that's the best way to take the best long-term profit will be made by people who do the right thing slightly better than all the other smart people. Because we're option traders. Everybody in the option community is smart. We all know more or less the same things. I have 17 years of experience. I know how to get a 0.1 over most other people. I can't teach you how to trade an Iron Condor in 5 minutes and just, boom, I've changed your life. But I can help you 1.1 until the point where you are way better than your competition. I did it in golf. That's why I was a professional. Of all the people that, 4,000 people in university teams or whatever it is, I mean, hundreds of thousands around the world. How do I get a world ranking? You wouldn't have known the difference between me on the tee box and everybody else. I'm just 0.1 better than most people, and Tiger was 0.1 better than me in all statistical categories. Not much. If I stood next to him, and I've played with a lot of the tour players, you wouldn't notice the difference. You'd think I'm Rory McIlroy, but I'm not. Rory is 0.1 better in all the statistical categories than me, and when you add it all up, he's Rory McIlroy and I'm me, an option trader who retired from pro golf. That's how it works. So that's how you view your option trading, and you will succeed much, much better if you view it that way. There's a few questions left, but I hate to drag on because we can always just do another live stream. Just a recap before I tell you, you don't have to go home, but you got to get out of here because I am just about ready for bed. Iron Condor course is coming. The community can appreciate it, of course, but if you want to check it out for a couple of months, I will not have my feelings hurt if you sign up for the VTS community for just 3 months, participate in the 25-part course, and as soon as I release the last video, you stop your membership. I won't have my feelings hurt, trust me. So anybody can go on the website and sign up for that, and I think we're going to be starting soon. In fact, I'm going to record the first video now. I've got the script, and I just have to record it and edit it, so probably next week we're going to dive into this. So if you've ever been curious about the VTS community, no pressure, of course. I don't do any marketing, but now might be a good time to consider at least a short-term subscription. So thanks, everybody. Again, massive apologies if I left you stranded yesterday. I do want to figure out that software. It's going to be pretty cool, but I shouldn't have done it on a day that was, I was teasing this Iron Condors, and I had probably more people than most ready to tune in, and I just completely butchered it. So sorry.